Hi, this is Randy Finney with the Right Side of the Chart, and today is Wednesday, June 1st, 2016. In this video, I wanted to cover crude oil and the energy sector, including XLE, the energy ETF XLE, and some of the top components of XLE in the energy sector to get a good idea on where prices are likely headed. The crude oil is an active short trade on the site via USO and or UWTI. That's the 3-time leveraged long crude oil ETF. My preference is often when swing trading to short the 3-time leveraged ETFs to take advantage of the decay. XLE, the energy sector ETF, which holds the individual stocks, as well as ERX, my preferred shorting proxy, the 3-time long energy sector ETF, was recently a trade idea. Stopped out. It just clipped our stops by pennies last week, and we're probably right about where we were back then. And I'm more than likely will be adding that back as an official short trade idea. I'm personally short it, and I think I will. Maybe by the time you watch this video, that might already be an official trade idea. All right, let's go ahead and dive into the charts. I'll make the case for a pullback in oil as well as the energy stocks. Starting here, we're looking at oil prices. This is an end-of-day chart. This chart is really very similar, same prices as the one I put up recently via stock charts. That's the lighter colored one, West W $WTIC. These are end-of-day charts, meaning you're looking at yesterday's closing prices. Crude, and it's not reflective of today. Now, on this draw, I have a slightly different draw on this chart, and in which case I've started the rising wedge or the trend line at the lows back in February. You can see here, and that comes up. That has us within the wedge. And today we're trading. Well, as I do this video, we were down. We're about almost flat right now on the crude oil, but either way, that should put us below that line or right on it. And you can see we're right there now. There's also an alternative draw that I have here. This is the trend line that I'm using on the other chart. If I come off these lows, we capture quite a few candlesticks. This one just had a slight pierce below but closed back above. So I put a lot of, I put almost an equal weight as far as the validness of these trend lines, or the validity, I should say. And that one had us closing just below yesterday. Again, that's the one similar to the one I put up on the stockcharts.com WTIC chart. So there you have it. That's the story, whether we're under there or not under there yet. We have broken below the 60-minute chart on USO, and USO is a big weight. A lot of money flows in and out of USO, and I think that'll ultimately determine, it can have an effect on crude prices just in itself, the positioning on the ETF. So there it is, negative divergences. This one splitting hairs. We made a slightly higher high on the RSI, but for the most part, the essence of a divergence is that's roughly an equal high. We did have a slightly lower high on the MACD with prices making a higher high, confirming the bearish nature of this rising wedge pattern. You can see the resistance line. What I like about the short on crude oil is not only the bearish wedge pattern. Now, we shorted last week, or about 2 weeks ago, I believe, in anticipation of a breakdown of the wedge. So we shorted near the highs. We're already positive on the trade from the original entry. And one of the things, in addition to the rising wedge pattern and confirmed with divergences, is the fact that crude oil has hit resistance. You can go back to the left here. Look at all the reactions. We have reactions, quite a few reactions here. You can see how prices held above that level. So that line, which is at about 50, 54, 50, 55, somewhere in there, you can go through and see that it has really defined. It's been an important level in crude prices going back for a while. Not to mention the fact that we're very overbought. You can see the RSI pushing that 70 level and above recently, so we're quite extended. And we'll take a look at one other thing here. Going back, this is a 2-day period chart. Going back a few years. But what I did, I put up some Fibonacci retracements from this reaction high here back in 2015, these double highs. So I started there. So the move down from this point down to the lows, you can see that so far this advance has stalled out or right about that 61.8. That's a key Fibonacci retracement level. And we had that move virtually straight up. It was almost an ABC viewed on this larger scale. We had one thrust up, a counter trend rally, which did help work off the overbought conditions, and another thrust up. So Who knows? Maybe this is a new 5-wave development for you Ellioticians. Just eyeballing this, I don't think that works because for this to be the P3, the primary third wave up, it's just too small compared to the scope of that, and the third wave should be larger than the first wave. So either way, I just wanted to point out the ABC up, if you will, the correction, and where we're at. And so far, symmetry-wise, it's a pretty equal move. Not exactly, but there's the initial thrust up, and there's that secondary thrust up, and we're looking at it here on a log chart. Doing arithmetic or linear scaling, it is more symmetrical because that doesn't adjust for the price differences. It's almost perfect symmetry there when you do arithmetic chart. Okay, now let's move on and take a look at USO. And then I'll roll into the energy stocks. That's where money can be made here shorting oil just as well. But I think there's a lot of attractive individual setups in the energy sector, which I'll go through. For those of you that prefer individual stocks or you can use the ETF. Typically, birds of a feather flock together. So if you can make a call on a few of the big names, which I'll do here in a second, and they're going down, the majority of stocks are going to fall with it. And of course, if oil falls, it corrects considerably, you'll see the energy stocks go down with it. And this is the 60-minute chart of USO. This is where we shorted, I believe, up here week before last. Everything has been highlighted here. The double negative divergence. We had a divergent high at this point. Prices continued up within the wedge, put in a second divergent high consecutive. That's why I call it double negative divergence, when you have consecutive or back-to-back, negative divergence and then an even steeper secondary divergence there. Trend indicators rolling to bearish right now. And as I mentioned earlier today, USO has come to backfill today's gap. We gapped down today, which definitely put us outside the wedge. Remember the crude oil charts I was just looking at? That was an end-of-day chart. So we did gap down on that chart today, and we pushed back. So we're really back testing the wedge if you look at that bigger chart, and we're still a little bit below it the way I have it drawn here on USO. Remember, USO is not going to track perfectly. It's an ETF, but it does a pretty good job, and it's very liquid. That's why I like to trade it. And there it is. I pointed out the gap backfill, and so far we've struggled on, since then, 2 additional 60-minute candlesticks where prices have failed to get up and close above that gap backfill. So my expectation remains for a reversal off this level. Somebody pointed out in the trading room today, is it possible to see a back test? Well, sure, it's possible. We're not too much farther. Back test of the line could happen here, could happen a little higher, but right now the charts clearly remain bearish in my opinion. Okay, let's look at XLE. We'll take a look here at start with the daily chart. Quite a few lines here, longer term, and I've made it clear throughout the year. I've been bullish. The vast majority of the trades this year have been on the long side. We've had some excellent trades in 2016 so far, some very profitable trades on numerous energy stocks, growth and income trades, regular swing trades, you name it. And, I like to trade long and short. Right now, I'm looking at just a pullback, and longer term, I think the energy sector still looks bullish. I want to make that clear. At least at this point in time. So I think we do need a pullback. You can see this downtrend line off the lows. Forget about all the other lines for a second here. This is the line I'm focusing on. Numerous reactions. We'll zoom in a bit so you can see all those reactions here, reaction, and a breakdown, crawling below it, back testing, and starting to roll over. So that's XLE from a daily time frame. There's some horizontal targets there. I'll get into that when I put up an official trade idea. I'll give you some price targets. But it wouldn't surprise me at all to see maybe even a back test of this downtrend line here. Let's take a look at the weekly chart real quick, bigger picture. Here's a bigger picture. Again, please ignore all these extra trend lines. I just haven't cleaned this chart up for this video. The salient points on this chart that stand out to me are the positive or bullish divergence that we had at the lows in January. You can see from prices from this point down to this point making a much lower low, almost about equal troughs on the PPO, which works similar to the MACD. And again, we're looking at a weekly time frame. So you have prices making a lower low against equal lows. That's still positive divergence. And that was the catalyst, if you will, or helped confirm this move up that we had. Now, here's a downtrend line. Not the most solid downtrend line. I say that because we have we didn't really have much of a reaction there, although we broke above it and back tested so far. That gives that trend line a little more validity right there. The fact we punched above it, came in and back tested. And, we had that back test, but it was immediately after. I wouldn't be surprised again to see one more back test. I also see some horizontal support around there, around 64.50. And then quite a bit of support down here with these yellow lines. Now, longer term, let's take a look at XLE. This I've covered. Last year was probably the last time I really touched on the monthly chart, and we were, in a rip-roaring bull market in the energy stocks, and I pointed out this bear flag pattern. There's a flagpole, the bear flag right here, but with this line and this trend line here, the bottom part. So there's your flag, and this was the measured move, which is the distance of the flagpole down into the bottom of the bear flag. You add that to the top of the bear flag, and that was my measured target last year, which was hit and then some. So we exceeded the measured move, and what that did, it also took out this long-term uptrend line all the way back here from 2002. You can see the white downtrend line. I had a parallel trend line that captured quite a few reactions as well. I mentioned that was significant, so we broke that one, went on to break the other one. So longer term, that was bearish, but that played out for quite a bit. We had a pretty hefty move down from that point. When it really broke down up here, broke down from the bear flag. That was the true sell signal back there, 75, 74-ish, all the way down to 50.04. So about almost a 30% drop. Pretty healthy correction. Now let's fast forward to today. All right, I also mentioned these RSI levels getting down to oversold readings, which have always in the past, you can see here, you get oversold, boom, oversold. And again, we're looking at a monthly chart, long term. Big, rare, very rare to see oversold or near oversold readings like we did here. And each one of those preceded some significant rallies, or I should say bull markets. And this is a double tap. The last time I mentioned that near oversold level was right here. And we had what I call a double tap, which is two consecutive oversold or near oversold readings in close proximity. So that's potentially bullish there. We have a pending, not yet confirmed, but a pending bullish cross on the PPO, meaning this orange line will come above the white line. That also triggers, long-term buy signals, as you can go to the left of the chart and look. The trend indicator here, this ROC 13, is still bearish, but you can see it's sloping up. Looks like it's about to make a bullish cross, as it did back here on these instances. So that helps for the longer term case. But again, monthly chart, and I think in the near term we're probably looking at a little bit more of a pullback. And remember, we're still according to this chart, still in a larger bear market within the energy stock, so they could go down quite a bit more. There's another pair I like to use on my monthly charts, the 20 and 17 EMA, and you can see the pair here is still in a bearish mode with that the 20 above the 17 moving average. So the fast line, the faster MA, which is a 17, needs a cross back above that 20 to help confirm a primary uptrend or a buy signal. Okay, now what I'll do, I'll move over my related items list. So this list contains the components of XLE, the energy ETF, and I have these sorted by market cap. The other day in the blog I had mentioned that Exxon Mobil is by far the 800-pound gorilla of the energy sector. It makes up a whopping 19% weighting of the XLE. So if you want to know where XLE is going, all you have to do is really know where Exxon Mobil is going. And so I'll move this list away off to the left of the screen here, and we'll go through these components one at a time in descending order of market cap. Again, starting with the big boy XOM. And I've shared this chart in the trading room, and I believe on the front page, not sure. This is a daily chart we're looking at here. You can see this long-standing negative divergence on the MACD and the RSI. So we had this divergent high here, prices making a higher high against the indicators and oscillators making lower highs, negative divergence. A very clean up trend line off the lows, just like crude has. Well-defined and a solid confirmed breakdown. And so far, some pretty impulsive move out of there. You know, Exxon Mobil it's not GDX. It's not going to go up 5-6% in a day. But so far, the candlesticks are, you know, we had a pretty impulsive down candlestick yesterday once that trend line broke, and I could probably tweak it, get it zeroed in right there. You can see it comes in perfectly on those candlesticks. So that's where we're at. We have a little bit of support here around 88.15. You know, I really haven't modified that line. I should put that line right there. That's where that support level would be, 83.53-ish, and we're flirting with it. We just moved above it, below it today a little bit, came back up. So that's a level to watch. Call it 88.50 to be safe. Once ExxonMobil's below there, that really opens the door for a move all the way down to this level here, 85.10. And that will almost certainly bring XLE and the other stocks with it. And there might be some more downside from there. Well, again, these are pretty large divergences. This was a pretty strong move up. So, you know, I think at best the energy stocks can be dead money. I'm clearly bearish. I expect some downside in the coming weeks to months. And maybe they trade sideways for a little while. And ultimately, a break above this 90-ish level in ExxonMobil, you can see going back here, we have a reaction high, we have a gap. Quite a few reactions. That would be bullish, but we're not even close to that yet, in my opinion. So there's ExxonMobil from a weekly time frame. I didn't really have a time to clean this chart up, but I did show this. This was a long-standing short on the site from not far off the highs, ExxonMobil and or CVX. I can't remember if they both were or which one was an official trade idea. But ExxonMobil, you can see this uptrend line, this large wedge pattern breakdown. And what I have here is a Fibonacci retracement, this line from the highs to the lows. And you can see where ExxonMobil stopped cold right at that 61.8 fib. You look over to the left, see the dotted line. So that, again, is a 61.8 retracement of the initial move down from their all-time ExxonMobil's highs back here in August of 2014. And that's a key fib level, so I expect that to act as resistance. And again, that makes a case for a pullback in ExxonMobil. Let's see what I have here on the monthly chart. I mean, this is quite bearish. This goes back 30-something years. We're going all the way back into the mid-80s. And this was an uptrend line or a price channel on ExxonMobil. Now, we kind of flirted through there, cut between it, hugged on the line, but we're clearly below that channel. So this longer term paints a pretty bearish picture for ExxonMobil, you know, from a technical perspective. Very powerful divergences leading up to the highs. You can see here negative divergence. This trend indicator recently flipped back to a buy signal, but you can have some whipsaws on the ROC 13. But either way, that's where we're at now. So we may be looking at a prolonged secular bear market in ExxonMobil. That's, again, yet to be determined. But right now I'm just looking out in the next few weeks to few months. Okay, I'll go through the remainder a little faster. Some of these can be, of course, as I said earlier, individual trade ideas for those of you that would prefer not to short the ETFs. You want to pick, you know, the most attractive short setups within the sector. You know, more often than not, given a sector, I can, you know, if I'm bearish on the sector, I can look within that sector and find the most bearish setups and outperform the actual sector on the downside or upside, flip it around if I'm bullish. Because when you short an ETF or you go long an ETF or short an ETF or a sector, you're shorting the good with the bad. So that's the point here, and I'll go through some of my favorites on individual stocks. Obviously XOM, I just made the case for that. Here's Chevron Texaco or Chevron Corp, CVX. Here's an uptrend line off the lows back in January as well. I have two alternative trend lines. I have this primary uptrend line here, which you can see as I zoom in. We've broken down, made a near back test, and we've rolled back over. I have this alternative yellow uptrend line, also broke down, and we've kind of moved sideways. And you can see this horizontal level here around 98, 93 that CVX needs to take out to really get going, and probably move down to this level here around 93.27. Negative divergence confirmed. Everything that I mentioned on Exxon Mobil, they look obviously very similar. This is a weekly chart just showing a retracement off the highs in CVX back in 2014 down to the lows, and you can see that CVX is actually stalled out at the 50%, another key Fibonacci retracement level, and so far is struggling with that level. All right, let's move on. SLB, Schlumberger, and let's see what I have on this chart. Longer term, it looks good. We had this downtrend line, very well-defined downtrend line, breakout, back test, and a move up. However, it'll probably be dragged down with the sector. I'll just be clear, not one of my favorite shorts. There's quite a bit of support down here. My guess, if it comes down, this would be my ultimate target, but again, I wouldn't short this one. I think there's more meat on the bone on a lot of the others that I'm about to get to in a minute, but call it about 71.60, maybe even find support around 72.66, somewhere around there. Oxy, Occidental Petroleum, OXY, here's your uptrend line. It is yet to be broken. You can see reaction, and we're just now piercing. We pierced above it intraday and hammered back up on it so far. I'm doing this video during trading hours. There's still a couple hours left to go in the trading day. And that one's also stalled out here at a pretty significant resistance level around 77.40. You can see all these reaction highs, some reactions back there. So that's OXY, and a break of that trend line would probably bring us down to this level here around 71.75. COP, ConocoPhillips. I don't know what that arrow is doing there. I haven't looked at this chart in a while. Let's see. We have a minor downtrend line that would probably show better on the 60-minute chart if you want to really zero that line in. So you sort of have this flagging pattern. Oh, I didn't mean to set an alert. I want to create a parallel trend line to create a bear flag. So what you have here is a nice uptrend line, pretty well defined. You also have, no, I was going to draw, you don't have divergent high, but you did have a wedge type pattern there, and you had a breakdown in this sort of bear flagging action. So your next sell signal on COP would be a break below that line, and again, you want to zero it in. You could look at a 60-minute chart or wait for a daily close below that, and that would probably take COP down to this level around 38.73. EOG. Eog Resources, another one, breakout, back test. Not my favorite. You could draw down an uptrend line here like everything else. You see the theme is very common. This is what I said earlier in the video. Birds of a feather flock together. That's why a lot of these charts look so similar. There's your downtrend line, but you also have, or I should say uptrend line, but you also have a downtrend line which could act as support here. And if that doesn't, again, I didn't clean this chart up ahead of time. There's a horizontal support right there, so I wouldn't short EOG. I would stay away from that one. PSX, I don't have much of an opinion on that chart. That's just grinding around aimlessly for the last couple of years here. KMI, Kinder Morgan. Well, we can put some levels here. It's certainly traded in a sideways range. That's a very well-defined support shelf. So any break of that would be bearish, obviously, and the top of that range is up there. So this one's range bound. I mean, traders, it depends what type of trader you are. Some traders love trading channels and ranges. You go, long at the bottom of the range and short at the top. Long book profits. Short, hold out to the bottom of the range. Cover, go long. Wash, rinse, repeat. That won't last forever. Trading ranges like this don't do. So just about the time you've noticed this, at least at this point, it's already been going on pretty much throughout most of the year. Sooner or later, this guy will break up one way or the other. But until then, you could try that strategy because it is low risk. Buying. If you buy here long, your stop is on a daily close or whatever you want to do, an intraday move, 60-minute close, whatever you want, just below that level. Likewise, if you're shorting at the top. And another way to also trade this is wait for a breakout. The longer a trading range goes on, the more powerful that is. That's energy building. So an upside break would be powerful, and the stock probably wouldn't blink until it got to this level here, that 23.30 level. That would be your first support or resistance and a target right there, with a next to resistance level or target just above that around 24.60. Now, if it breaks on the downside of the range, again, I'm near-term bearish on the sector. That's probably going to take us to at least this level here, 1592, and that's, you know, a decent trade. It's not huge, but that would give you about a, what is that, 5% gain. And in this market's been tough. Probably better to take quick profits, not try to target the big moves. But if KMI takes that level out, and again, I can only assess things as they go, then you're talking to move down to maybe 1430. I didn't point it out, but we did have a divergent high in KMI recently on that last tag at the top of the channel. I'm referring to from this point here to this point here, prices making equal highs with the RSI and the MACD making lower highs. So there's negative divergence, and that may play out for a downside break of this, particularly if the energy sector continues and heads much lower, I should say. Halliburton, pretty clear pattern, bearish rising wedge, divergent high, you can see right here, the negative divergence drawn, bearish rising wedge pattern. So this one's a nice looking setup. A breakdown of this trend line right here, that one's off the February lows, would bring us to this level more than likely, 38.58, with a secondary target at 37.13. Okay, at some point I might have gotten off my list. These are all energy stocks, but I clicked on one and I may have populated something else on my related items list. I'm trying to pick up. I know we just covered HAL, I believe it was. All right, let's move on. Either way, again, those were all energy stocks, and the notes and charts that I just showed you are valid, whether that was a component of XLE or not. HAL definitely was back on the watch list or the components of XLE. PXD, Pioneer Natural Resources, it's a big company. That's about a $26.5 billion company. This one's has a clear pattern of these uptrend line breaks. You short these uptrend line breaks, and you have nice swing shorts. Uptrend line, breakdown, back test, boom. And here's an uptrend line, breakdown. So you fill in the blanks. There's support right there, 157. Once it drops below 157, which is my expectation, this one will probably move down to at least that 158.38 level and could continue quite a bit lower. Again, we'll just have to, assess the sector, how it goes. If I'm trading these individual names, I'm trading these with an eye on XLE, with an eye certainly on crude oil, with an eye on XOM, the big leader of the sector. So ultimately we might go down this far for 140.60. A few more to go here. APC, nice. Here's some negative divergence on this bearish rising wedge pattern, right up into a resistance zone. You can see a gap back here. This is a very significant resistance level here around 58.15. And we never quite made it all the way up there, but we did make it up to this gap that happened. This gap kicked off. Well, there was a breakdown, then the next day a gap, and that stopped the advance of APC cold, and we broke down below the bearish rising wedge, and we've had this. This is a little bit long in the tooth for a bear flag, but it's whether you want to call it a bear flag or a rising price channel, ascending price channel, the net effect is the same. The trend line, the lower trend line, is support of that pattern. So a break of this lower trend line would trigger the next sell signal and most likely bring APC all the way down here to 43.70 roughly. So that is a move of, just to try to quantify it, using my measuring tool, you can look in the upper left hand corner. That's about a 14% drop. So a lot of meat on the bone on that one. And that one I do like as a short trade. Okay, a few more we'll do. VLO, this is a big support level here, and I wouldn't short that one. I would definitely stay clear of shorting that one. APA, Apache, nice bearish rising wedge, confirmed with negative divergence like a lot of those. I should add another support level here because we have these reactions back here, some reactions there, and that would be your first target around 51.80. And again, when I say these targets, these are the actual support levels. They're unadjusted for an optimal fill. In other words, I like to set my buy to cover orders just above the actual support to prevent if that's where everyone steps in to buy and they step in a little bit early. I don't want to have that trade reverse on me just shy of the actual resistance level and miss a fill. So the second target, I would have to move this line down here and tell you that would be at 46.73. And if things get really ugly, we'll probably go down here to 42.31. Okay, a couple more. SE, Spectra Energy. Look at this nice resistance zone. Back here it was support, and that's where so far SE is at the bottom of that resistance zone. Could push up a little more within this wedge, but I think if you shorted it here, it's right at the top of the wedge and the bottom of that resistance zone. And that top of that resistance zone, which is very solid resistance in my opinion, is 3261, call it. So you have about you have to set your stops a little bit above the actual resistance. In this market, especially a low volume market, they're good at blowing out and running the stop. So if everybody has their stop right at 3262 or just above there, they'll probably run it. So you want to probably give it an end of day close above, call it 3286. So what does that do? You have about 86 cents or 85 cents on the downside if you're stopped out. But if you short here at the top of the wedge, or you wait till it gets up there, that would be an ideal entry right around 3260 with a stop not far above, 20 cents or so above. I expect prices to go on to break the downtrend line. I should say this minor or secondary uptrend line that forms a bearish rising wedge pattern. You can see that bearish rising wedge pattern is confirmed with negative divergence. This is your primary uptrend line off the lows back in December, and that line will be broken as well. So I really like this chart because you'll have a dual break of break of dual uptrend lines if this secondary line is taken out, the white trend line. Price targets, I can see some very nice support right here. That would be my first target at 2881-ish. Set a little bit above there, and ultimately, again, if things get ugly in the sector, then this one would prove to be a very nice swing short all the way down to almost a $26 area. So, from 32, where we're at now, 32.02, all the way down to there, that's almost 19%. And if we went to that first target, you're talking about 9.7, right up, 9.9, so about 10% from current levels. And BHI, Baker Hughes, broke out of this uptrend line, the downtrend line recently, came back below it. Sloppy trading action. I wouldn't touch that one with a 10-foot pole. I don't like it long or short. It is below resistance right now, but it's traded through there, so just leave that one alone. Hess, nice ascending price channel, very well-defined uptrend line, breakdown, and prices moving higher, sort of like a lot of those in that flagging type pattern. You can see the bear flaggish action. So you're right there. You don't short it here. You could short it here. I think these are all going down, but at this point you're just dancing right on that near-term uptrend line right here. So why not just wait for a break of that and give you a little bit more objective entry? And if so, there's your targets: 54, 55, and 48.88-ish. Call it 48.90. Maybe move that up a little bit. Yeah, in that case, probably cover right around, say, call it 49. Devon Energy, DVN, same story. Rising wedge, breakdown, prices pushing back up to this pretty key resistance level here, 37.20. You can look at the reaction high there. We had a gap right there, a couple reactions right here. So there's your, again, these are just objective short entries in my opinion. It's at 35.65 now. 37.20 is a very significant resistance level. So you set your stop a little bit above there. If you can give it room, do it on a closing basis. And this one should really get going. Of course, if the crude short plays out, keep in mind that a lot of this hinges on the crude short trade playing out. But you even have a divergent high on that one as well. You can see here because prices came up to make equal highs right here, and both the MACD and the RSI were lagging. So your next sell signal is on a break of this minor uptrend line right here, and a couple more. MPC Marathon. This looks. I marked this because it has the appearance of a head and shoulders pattern. Now, you have to be careful. Head and shoulders patterns are one of the most easily recognized patterns out there in trading, and I think they're overused. I didn't confirm it with volume. I'd have to look at the volume patterns, but this is more indicative of a head and shoulders pattern because head and shoulders patterns are topping patterns. They should come after an extended move higher, an extended uptrend or a bull market. And so in this case, you had a left shoulder, you had a head. It didn't have perfect symmetry. You could say two left shoulders. This would be your first left shoulder, second left shoulder, which is possible. They call that a complex head and shoulders pattern. There's your head, right shoulder, breakdown, had all the components. This is typically what happens when a pattern breaks down. You have impulsive selling, and this one, I'll bet you, watch this. Let's just, for fun, do this. There's the head. You take to get the measured move of a head and shoulders, you take the distance of the head down to the neckline, and then you add that to where the neckline breaks, or where the pattern breaks. Look at that. That's where the initial thrust took you. It was very close to the measured move on that. And then you had this consolidation and another thrust down. And that's also another thing in technical analysis. This looks like a bearish pennant continuation pattern. So you had that initial thrust down, you had this continuation pattern, and then, just as is often the case, you have a thrust down, and to take a measure out of bearish pennant, you take the length going, the move down into the pennant, the impulsive move down into it, add it to the top of the pennant, and that's where your measured move. Sometimes you can add it to the bottom. That's what happened here, and it played out pretty well. Since then, nice move up. And it has the appearance of a head and shoulders, and sometimes these things, even though a head and shoulders wouldn't come, they have to come, or they're supposed to come, I should say, after an extended uptrend. This one, it came after, right off the bottom, so that's why it doesn't really fit. I just wanted to point out the symmetry there. Some people might watch it, and some people might trade it that way, so a break below that level would be bearish. There's an uptrend line. We had a breakdown and back test. It's not one of my favorite. I just wanted to point out a lot of technical stuff going on there, and I'll wrap it up with the WMB. This was an official trade idea on the site recently. We hit the second target. This was very profitable. Still has a nice dividend yield. It was a growth and income trade, but I think we milked the bulk of the initial move up on this one. But as I mentioned, if you're a dividend investor, there's nothing wrong with holding on to that. And if you're still in this one and you're just holding it for the dividend, you want to tuck it away, this is what I would watch. See this uptrend line off the lows, pretty well defined. Going there, numerous reactions off there. So if you're holding on to this one and would like a trailing stop or want to know where to take profits, if you let it run after the second and final target was hit, I would look for a daily close above this uptrend line. That would be my stop. And if you want to get back into it, probably looking at a pullback to backtest this downtrend line. The yellow downtrend line would be most likely the most objective entry. But again, I can't tell you right now because it all depends on where the sector is. But if that came in, I can see very nice support right here. I'll make this line. I'll tune this one up, make it yellow. That would be an ideal target right there. So that yellow line was at 1858, and let's just draw it out. So pull back to that level. That would be intersecting support, both horizontal price support as well as a back test of the downtrend line around 1860-ish, and then that one could continue on higher. So, all right, this has been Randy Finney with Right Side of the Chart. I hope you enjoyed it.